All right. We are in the middle of going live here, so we'll wait a couple of minutes until we are up on all the platforms and live. But thank you for everybody joining in right on time and early. We'll definitely give some people a chance to jump on. All right. Hello to everybody in the chat.
We'll keep the chat up while we
get there you go. Keep the chat. Keep it going. Hello, everybody checking in. Good evening. Just still sending this out here, making sure we're live on all the platforms before we get started. All right. Shout out to everybody in the comments. Thank you for tuning in. Good evening. Good evening.
Someone from LinkedIn as well.
All right. Yeah, it looks like we're live on all the other networks as well, so we're almost good to go here. Thank you to everybody checking in. Should make it a DSCR Tuesday, Adam says there in the comments. It's DSCR Tuesday. Every day is DSCR day here at the Mortgage Calculator, for the most part. Just DSCR day, all day, every day. You know that we love them. A couple of people talking about the Mortgage Calculator swag. Yeah, come meet us at some events and stuff and get some. We're all over the place. When you run into us in person, we typically have some gear and some swag and stuff. We'd love to meet everybody in person as well. Okay, looks like we are live on everything. Thank you, everybody, for tuning in. We'll go ahead and get into the agenda here for today. So today, we're going to talk about how to structure DSCR loans. That is the training here for today. So we're going to do this in a couple of parts. First off, Jose is going to talk about DSCR loans and how to size up an actual deal. So we have an example of an actual property that's for sale, and we're going to size it up and see what kind of DSCR loan we should go with for this example. And then Nick is going to show us how to actually structure that in Encompass. So we're going to get kind of both sides here tonight. We're going to get the front end of finding a deal, sizing it up, figuring out which loan type that we could offer to our clients and go for, and the other end of actually setting the loan up and originating it in Encompass. So with that being said, let me go ahead and send it over to Jose so he can pull up the actual property that we're talking about, the real life example, and then he'll go over some quotes for that property. Then Nick will talk about how to set it up in Encompass. Again, thank you everybody for tuning in. Thank you to the Mortgage Calculator team. Thank you everybody checking in on the comments.
And for anybody who tuned in last night, this will be a continuation of the property we went over last night. So we had the show Does It DSCR podcast that we did last night, and this is the same listing we did from there. So we'll just continue on and put the whole deal in on the loan side. So
all right, so I was just getting my 3 quotes up, but the one thing I needed up is the listing. So let me grab that on another screen a minute. Give me a second, Nick, so I can pull that one up.
Okay.
From RPR. And then I'm going to bring it over there. In the meantime, I'll just have my first quote up, which is a 20% down. Non-DSCR. So when I look up the property, let me give you a little backstory here. This is a listing that is a short-term rental. So this listing is actually being used as a short-term rental. However, we're using it because obviously the listing is being marketed to individuals that will be obviously looking to keep using it as a short-term rental, because it's pretty simple math here. The long-term rent, let's say 9,500, let's say maybe even 10,000, right? For the long-term rent. So we're not, we'd still be at a less than 1.0 situation here using long-term rents. So yes, we have the options, but first let's talk about business and the sale of the property. Now long-term rent, if we're looking at it's about $1,197 per night average rent right now that property is getting based on actual data. So we don't have a full years yet, but based on actual data, we'd be looking at a 60% occupancy. Here, let me pull it up over there. Come on. All right. So we'd be looking at a 60% occupancy. We'd be looking at $21,546. I think that's 60% of occupancy on a 30-day month at 1,197. So 21.5 rounding, nice round number, is more than double 9,500, right? So obviously, big DSCR benefit there to do that route. So that's how ideally then that's only going to happen if we can put that income on the 1007. That's the critical component here, right? So now, because getting back to DSCRs in general, DSCRs are going to tell you that it's the income divided by the gross rent. Gross rent divided by housing expense. Give you your DSCR. So in this scenario here, it's a big difference if we're at 21,000 divided by 11,023 than if we are at 9,500 divided by 11,023. Two different programs. So with that being said, the 20% down option that we have here, in this scenario, we've already determined, and if you can
you share your screen, Jose? We can't see anything.
I did. It's there. I can see it in the background. And my share screen is.
Do you have the listing? We can't see the listing.
Oh, the listing. Oh, you mean the listing? Okay, you want me to share the listing? Okay, let's talk a little bit about the listing. That's right.
Correct. Yeah. Nobody knows what rent you're referring to there.
Yeah. So at 6, this is the real live example, because this is a property that's currently for sale, right? And it's current listing, and basically it's a duplex, which is set up as 2 units and like a separate an additional in-law quarters that has additional kitchenette facilities and bedrooms and additional privacy. So it's a really interesting compound. You got the pool there in the front, so everybody can share. So it's only rented the complete property. It's not, so you have 3 individual living quarters per se, 2 kitchens. There's plenty of parking. So, there's one of the interior living room areas. So a lot of areas for big group. It's a functional fireplace. So cool home. A lot of stuff. Well, here's our floor plans. You can't see it in this photo here. We have to go full view. So talking about some of the data here, let me get you on one of the kitchen shots. A lot of rooms in this place. That's why it rents out to big groups all the time. There's one of the kitchens. So we have 2 kitchens, 1 kitchenette. Doesn't have a range. So getting back to the numbers here, let's Let's get the aerial shot. Fully furnished, being sold, fully operating income-making machine. So there we are. There we are right here. This little quadrangle here, obtuse angle a little bit there because the street does, a little bit of an angle. And there's the New River. And this is downtown Fort Lauderdale here. And you got Las Olas action going on over here. There's a whole bunch of action. And the beach is about 5, 6 blocks, 7 blocks to the right here. You got the bridge. And this is a water taxi. So there's a lot of stuff going on. Hence, the short-term rental income. So that's the message that we're conveying. So when we now talking about the income, right? And we're talking about 9,500 versus 21,500. Now, in this scenario here, which is the 20% down option, this is the only 20% down option that came up in all of the programs that we have. So, we'd want to make sure that it's doable because every other option at this loan amount, because here we're talking about not even having to do a short-term rental. We're talking about having to do with doing a $1.56 million loan, DSCR at an 80%. This is the only option that came up. They do have some restrictions in the short-term rental income. We'd have to look at the guidelines because I think some changes may have come this week from this particular program. But on my last check, they were still only allowing short-term rental on the refis where you're showing 12 months of activity. They're gonna get that 12-month number and they're gonna give it a haircut of, I think it's 25%, more or less. I think so. You're getting like 75% of the platform. So if you have it on 3 platforms, you get 3 platforms. But on a purchase, that's a little bit stickier situation. That's where if it doesn't long-term rent, then you're stuck there because that's how they were accepting on being able to document. Because remember, we're talking about DSCR is income divided by housing expense, and the income in this case they require either long-term rent via 1007 or if it's a refi, the 12 months history.
So this one was a no, correct?
Right. So yeah, 9,500 divided by, in the best case scenario, 11,023 ain't gonna make it. And the no ratio option, the option that goes 0.75 to 0.99, we'd have to look at where we are there at 9,500 divided by 11,000.
The payment with escrows is 12,325.
Oh, excuse me. Yeah, I'm looking at multi-payment. Yes, but it's even higher. So yeah, so we're here there. Yeah. We're gonna definitely have an issue there because we're below 0.75 for sure.
Mm-hmm.
Let me see, 12,325, 0.77. So we're there, but the 0.75, the 0.99 option, in this case, some have a 0.85 option, but their LTV is 75 on that option because not just because of that option, but because this particular program doesn't offer an option below 1.0 to take it to an 80. So once we go below 1.0, they all go down, especially at that loan amount is what it boils down to. Also, they go down to 75%. So that would be if we were doing the option of no ratio, but we don't have to do that option. We have one that's a little bit better rate that allows us to use with 25% down. And mind you, this is more because of the loan amount, because this same option is available, short-term rental options. If we're doing a loan amount, I believe probably below $1 million. I'd have to check the exact threshold there, but probably somewhere around there, that they go to the next level of LTV, stuff like that. So they drop it down. So in this case, 1.56 million, we're 25% down, which is still a very good option. And in this particular program, and see, I got the income calculated there, right? So in this particular program, this option allows for the use of short-term rental income for a purchase, as long as it is placed on the 1007, and then they don't add any LTV adjustments. So, it's not, again, I have there, it's not going to work on the long term, but at 1197 a night at a 60% occupancy, you're at 21,546. So you're way above where you need to be, So again, we have here where the options would be either no ratio if we need to, if for whatever reason we can't get the 1007 to have short-term rent comps like that, then we would have to go no ratio, which is going to be the next option.
So this one is a yes, as long as we can get short-term rents on the 1007. So this is our preferred option that we'll try to set up in Encompass first.
Yep.
And then we have a backup option in case we can't get
now there was one of the questions there that said, will the lender not accept current owner short-term income? Well, that's something where we would have, that's a case-by-case situation. We could ask. They were accepting that, just like they were accepting pure air DNA. The reins tightened up a little bit, in this volatile market that we've been in. They had to add some more value to the packages, and the way that they did add value to the loan packages was by tightening up the guidelines a little bit. So most of them cut out air DNA, and most of them cut out using the seller's documents. And the logic here, when I asked them why, was because in some cases they wanted to see short-term rental experience from the owner. I don't know why. I guess because they're saying
it's different management too, right? So
yeah,
that's have a crazy management, but they take half. Some people could self-manage it and make not as much, but profit a lot more. So it's a really, it's a case-by-case basis. So it makes sense.
You hit the nail on the head right there, Nick. Totally, because that revenue was generated by another management, and the comps are comps. Yes, it's also subject to management, of course, but for whatever reason, they do look at it in that manner. But again, reach out to for the AEs or scour the guidelines. They are continually, changing almost daily, so they are loosening up again the guidelines, and rates are also getting lower. I think I've seen rates drop on DSCRs since December, probably like 2% have dropped on DSCRs, which is just due to the additional liquidity and appetite. Business went down, and now they have to do deals. So look at these rates, 7.25, pretty amazing. Lowest cost option is at I think 3/4 of a point is 8.125, and then you can buy it down. With this particular option, we don't have any limit on what they can pay and buy down, so we're not limited to 5% total in total fees. So there's unlimited buy down, and whatever the minimum is available on the rate sheet. So 75% rate. So what happens again if we got to go pure no ratio? For whatever reason, at this loan amount, that's going to be a 30% loan to value. If you have to go for whatever reason, you do the math, you got to go the no ratio. Here's the payment with escrow. Remember, we're at 9,500. So even at a 70, we don't make it. But at a 70 going, full DSCR, but at a 70 no ratio, which is this particular option that I have here, and which, the rate does start a little bit higher on this one. The lowest cost option is 9.875, but here the lowest cost option is a 1/4 point, more or less. Yeah, because look at that, 48.88 of so it's a little bit more than a 1/4 point there, like 0.375. So I like to put all the options on there, all the way to the lowest rate that they offered, 7.875, and buy down like 4 points roughly, 3.5, 4 points. So still very good rate for this worst case scenario that really isn't that bad, because this is a 30-year loan, fully amortizing. This is not an ARM. This is not a teaser rate. This is not a buy down. This is what it is. It's great to it's a problem solver. You got that trophy property that's not cash flowing for whatever reason. And this happens with those real expensive type properties in like a nice ski resort on the side of a mountain with a beautiful view. This thing is going to rent for like $10,000 a night during the high season. And it's going to cost $1.8 million, $2.5 million, something like that. And you're not going to be able to get long-term rental comps to work, Definitely not. That's just, but those are you're probably not going to have any long-term rental comps even available in that area when it's a real short-term rental property like that. So, this program is really right up the alley of that type of property. It's when we're trying to put the square peg through the round hole that we're trying to get the problem. The property with no short-term rental comps anywhere around it, no short rental comps anywhere. It's in the middle of the desert. There's nothing around but rattlesnakes and sand. And then you're going to do a short-term rent. I mean, they may not even be able to find comps for that period. So, learn to size up your situations, I guess, when you're doing all that.
So this is the guaranteed deal, correct?
Yes, sir. This is the slam dunk. But it comes with setting the proper expectations to the customer. They're all slam dunks if it was the right deal for what the customer needed. It's when we try to force it, and then because we didn't fully read the guidelines and see all the pitfalls that we could have, and then all of a sudden we're not going to have that problem, because we have these multiple layers of QC checks, including our internal underwriting and everything, which will hopefully catch this before it goes to final underwriting. But yeah, I mean, things happen all the time when we're going over a file. You're ordering the appraisal. There's no guarantee what's going to happen with that 1007. No guarantee. So why don't you show us that, man? I mean, if you were,
I got the system pulled up. So
which one are you gonna go with? Are you gonna do the 75?
Yep. Let's set up the 75, because obviously that's what we're going to try to pitch to the customer, and that's what we're going to try to add value by doing something that nobody else can do, right? So,
and mind you, this is at this loan amount, 75. This same option at a lower loan amount is available at an 80. Mm-hmm. This is just almost $1.6 million. So
let me swap. Okay, did it automatically. Perfect. So, yeah, let me take over here. Jose, leave that up on your screen, and I'll swap it in and out as we need. So I'll just swap the screens. And I know this is hard to read, guys. Hopefully you can full screen it where you are. Fortunately, it doesn't really let me zoom in or anything. Well, I guess it does here. Let me zoom as much as I can. I could probably go a touch more. There we go. Okay. So I'm zooming in as far as I can. Hopefully this helps. Actually, I could probably, I need to have my menu there. This will be good. So I want to go over how to set up exactly what Jose explained in Encompass. So again, this is for our team. I know there's some loan officers out there that are watching that aren't on our team. No problem. Hopefully your Encompass or Calyx or whatever you're using looks the same. We have some special stuff set up. So, follow along. You should have most of this, but probably not all of it. And for our team, obviously this is our setup. So we're going to use a John homeowner. So this is not a real person. Don't worry. No private info is going to be shared. We're going to go through John homeowner, which is the Fannie Mae test file that we're all supposed to test with. It does have, fake credit and stuff we can test with. So this is the one I like to test with. And this one's already set up, excuse me, as a DSCR, the test file was imported to the DSCR, but let's just go ahead and start with the first thing we're usually going to set is the loan program. So we already set this up as DSCR, but make sure whatever your company is, you should definitely have your different programs, and DSCR should be one of them. So I'm going to click DSCR just to make sure that I have this all set up before we start putting in numbers. And our closing costs at our company, we have our non-QM closing costs for any DSCR non-QM loan. So that'll set that up. So I'm going to make sure that's set up. And the rest of this should be good. All right. So for this initial setup, it's going to be a purchase. It's going to be investment. Those were already set by the DSCR because DSCR is only for investment. Our gross rents. So Jose, first question for you. So I guess let me swap in the screen real quick. Did you have that analysis here? Can you it's at the top of your screen there, right? Can you scroll up a little bit?
Okay, yeah. Let me do that.
Maybe you could zoom in. We should have you zoomed in too when you do these. But you see Jose there. I know it's hard to read for you guys, but it says 21. Yeah, see if you can zoom in a little bit there. There you go. Yeah, much better. 21,546 is what Jose calculated as what he is expecting to come back from the appraisal if we can get the short-term rents. So if that's the case, we're going to put that as our gross rents, right? And that's going to help calculate our DSCR.
The other thing to consider on that now, that when you're using that option, you have to check if they do a haircut.
Yeah, I'm going to put 75 here. Normally, every DSCR loan, we're going to set up 100%, but in this case, we're using short-term rent, so we are going to get a haircut. So I'm going to use the typical, conventional. We always have to use 75, right, as our typical haircut on conventional. And in this case, this investor is going to require us, if we're going to try to use the short-term rent, we're definitely going to get a haircut on that. But we'll see how it works once we put in all these numbers, right, guys? Oh, I guess I should have swapped out. Let me. So this is where I put it, guys. You probably didn't see that when I was copying it over there. 21,546 goes in gross rent, and then occupancy rate I put at 75 because we're going to give it a haircut just like conventional. So conventional we put 75. All DSCRs we always put 100, but since this is a short-term rental DSCR, we're actually going to go back with a 75 haircut there, just like conventional. All right, now it's going to be purchase. We'll go ahead and put other and put DSCR on the loan type just so everybody knows what's going on. And we're going to come in here. The purchase price, you did the full 1,999,990.
Don't think so. Let me let you know in a second. I think I did 1,995,000.
1,995,000.
Yeah.
All right. Just so we
actually, this one gave a loan amount of just under 1.5 million.
Okay. And then the down payment is 25% in our example. As Jose explained, if we weren't going for such a ginormous loan, we might be able to get this to a 80 LTV, 20% down, but this is one of those big boys, right? And this is typical, right? This is the exact property that your clients are going to request to short-term rent because this is literally for sale. It's literally the closest house to downtown Fort Lauderdale, like the #1 tourist destination in the North Broward area. So this is like the exact example. Now let's go. We'll put estimate closing date just so everything works, right? We always want to put that. Now our rates. I'm going to erase qualifying rate. I hate using that. Please erase that, guys, when you're messing around. Qual rate's only if you have like a HELOC or something that's going to qualify at a different rate than it's going to actually be or something, right? So typically this is only going to be for adjustable rates or HELOCs, things like that. Don't get stuck putting qualifying rate and forget to update it and mess up your DU if you're doing DU, or in this case, we're going to mess up our DSCR and stuff if we accidentally keep something there. So what is our note rate there, Jose? Let me swap it in. You want to go with the low rate example? What would you pitch to your client here, Jose? You're muted, bud. I think you're muted still, Jose.
Yeah, I mean, if I'm looking at the progression of the cost, doesn't really change much It does get a little cheaper. It is a little cheaper at like from example, 8 to 8. But
So
I mean, it's
I
only
think
like
eight's the money
$130,
shot right there for me. I think eight's gonna be the money.
right? Because that's at that point. Now you're looking at, for each eighth of a percent, it's $7,500 roughly, and they're saving $140. So I
Yeah.
don't know.
So in my quick analysis, right, to go from 8 to 7.875 is going to cost them $7,000, but to go from 8,125 to 8 is only costing $2,000. So I'm always going to recommend my client takes advantage of the 8 and really thinks hard about going to 7,875 or 7,775, right?
It's 54 months basically to recoup the
The
extra cost with the extra benefit. I mean, and it's not much of a difference in the amortization of the loan either, which is
yeah.
another benefit.
So I'm gonna choose 8 though. I think that's the best bang for the buck, and I think that's going to be our best option in this case. Now we're starting to pencil this out, and we can see that our gross rent is right here, 21,000, because well, it's actually using the gross rent. So in this case, we're going to have to just reduce it, Jose, on the face value. So let's actually, just so our calculator works, let's put it 100. And what's the actual 75 value?
I don't know. I'll do the math. 21,546. So it's 21,546 times 0.75, 16,159.
Yeah.
Rounding
So,
it down.
just so you guys can see here, this is our DSCR because it takes our gross rent, which, in this case, they're going to take a little bit of a haircut. So our actual number we're going to have to use is 16,159, and it's going to take that over our PITIA. Now, our PITIA is probably not correct, so that's going to be our next step. That's why I want to make sure we're dialing in, right? We're dialing in here. We're good. But crappy insurance quote can throw the whole deal, right? So we got to keep paying attention. So let's get in here into the monthly payment pop-up, and let's see what we got. Definitely not correct, right? This ginormous house is not going to have a $100 a month insurance. What did you put for your estimates there?
I used actual figures
Mm-hmm.
that the property is experiencing right now. So the yearly taxes, because the system had me put it yearly. Right now, they're still got the low taxes. So the yearly taxes are 5652.15, and we divide that by 12. We got 471.02 as the tax amount. And the insurance is a little high because and this is just using the hazard and the flood. I didn't put the liability in here. So the actual figure right now, 99.77 divided by 12, that's 831.42.
I know this is small, guys, but I was just typing in Jose's numbers there. So we're putting the actual insurance and the actual property taxes. Hopefully you can get that from the listing agent too, right? The listing agent shouldn't be withholding of this type of information because these are the make it or break it type things, right? So these are the things that you want to ask the listing agent. What is the gross rent that you estimate? What is the current taxes? What is the current insurance, so that we can run our numbers and get that listing agent a solid qualification.
But if that doesn't work with them providing the insurance amount, you can always get a quote from whatever agents that you're building relationships with.
Exactly.
So that you can use, because definitely you want to be submitting once you submit the file with at least a quote. You don't want to just guess and do an estimate. And because like in Florida, for example, those of you that just got your Florida license and haven't been doing Florida loans, don't ever do that, because you'll be in for the rude awakening, because insurance here is super expensive. Like a typical 1,500 square foot home in Florida, unless it's like a brand new home that just got brand new roof and impact resistant windows and all that kind of stuff, a lot of them don't have that. That house is going to pay $5,000 in insurance to $5,500 in insurance, and that's just the home insurance. If it needs flood,
you guys, it would be just
elevation.
to Jose's example. This is a house that was a single family home, so even if the lady kept living there that lived there, it would be the same amount, $831 a month for it was an older lady, right, that had it. So doesn't matter if it's short-term rented or long-term rented. That's the straight insurance cost on that property for that size of property in that location.
Now, with that being said, though, when you are getting the quotes, and this is sort of an aside, but a really important bullet point here, when you are getting the insurance quote and the borrower is going to be taking title in an LLC or some other type of entity other than a personal name, you need to let the agent know, because they would have to make sure that the policy allows for short-term rental use and or ownership in an LLC. So I had one the other day where my borrower, this was one of our MLOs actually, where I did their personal loan on an investment property they have. They were insured through some non-standard carrier, Lloyd's of London, which is a name everybody hears. Lloyd's of London, they're like, great company. Yeah, it's super expensive because it's like a non-standard carrier. They just do whatever they want and charge whatever they want. It was $4,190 a year she was paying. They're paying in Jacksonville, Florida, for like a small home, 1,700 square foot. And the agent says, okay, now you gotta raise it. The agent didn't want to provide the RCE, right? They didn't want to provide the RCE, so it was, which is a replacement cost estimate. The Florida agent says, I don't gotta provide it to you. Okay, so the borrower then had to increase the coverage up to the loan amount. So the borrower is getting screwed by the agent. And I'm like, I was, I didn't want to take business away from the agent. They've had this business, but I just couldn't hold myself back any longer. And I had to save the deal. And it was struggling because they were waiting for the renewal. Okay, fine, but I don't got the renewal to give you yet. So I'm like, man, this is like a comedy of errors. So I said, let me get you a quote from one of our providers that we use. And I was able to get within a couple of hours, because our borrower had the prior 4-point inspection and wind mitigation already from like 3 years ago in her name. Great. Within a couple of hours, I was able to get a bound policy with my invoice to be collected at closing for a brand new policy. So I didn't have to wait for renewal. And by the way, her renewal was $4,500. We got the new policy for $1,073 with the short-term rental endorsement. So, food for thought.
Yeah. All right, cool. Let me pass through these couple things for our team here, guys. If you're not on our team, these might not be in your loan system. But let me set these up now that I kind of have the numbers penciled in. So now we can put the non-QM type, non-QM income type. So obviously this is our DSCR program. This is a non-TRID loan. It's not a portfolio loan, and it's just one property, so we don't need to put this. We do have to fill out the business purpose use of funds because it's a business purpose loan, and this is to buy a investment property, right? A short-term investment property. And now that we have all our figures, 16,159 is going to be our rent we can use, and our PITIA with the correct numbers that Jose just gave us is 12,281. So our DSCR on this is going to be 1.3. So we're going to blow it out the water. Perfect. This is exactly what Jose wanted to set up. But again, this is going to depend on us getting that actual 1007 with not this number, but the 21,000 figure we had before written on it, which then nets us this number, right? People on our team, make sure you fill out all the blue stuff. We have to have title insurance. We have to have, buyer, seller, agent, all that stuff. The next thing that a lot of people overlook, especially on our team, we always have this pre-check because all our DSCR loans will come with a prepayment. If you're in a state without it, make sure you uncheck this. Remember our template. So whenever you add this template of DSCR, it's going to check because 90% of the loans we close DSCR are going to have a prepayment. It's going to pre-check this. So if you're in like Ohio that doesn't allow it or something like that, make sure you uncheck it. And if you do have it, just because it's checked, just for safety, just when you disclose, so it's checked, you still have to set it up. So let's set this up now. Jose, it doesn't say in your quote there, but what is the structure of this PPP that you had quoted there?
Well, it was a 5-year prepay, but okay. What we do when we set them up,
so we like 5 year here, so 5 hard years of 12 months each. Okay, and then what?
and then we like to go 5% all the way through on that, because that would be the most restrictive option, and then that would give us more flexibility if we have to move the file around to different loan options.
So this wasn't a fixed 5% quote, but
No.
you want to disclose with this. So this is for our team. This is again a safety feature, guys. In case you have to switch or your customer wants to switch to a program with a 5-year fix, now we've disclosed and we don't have to redisclose and restart the whole file again, right? We can always lower the prepayment penalty. So start at the highest amount that possible out of any program that exists, and that way you're safe. So that's exactly what I wanted you to say, Jose. The penalty is always going to be based on the unpaid balance typically. So this is how we would set it up, and this will put in our disclosure package the full 5% times the loan amount, which would be the max prepayment, which is what we want to disclose. We want to disclose the max prepayment for whatever program we may end up closing with, and if we get a better deal, great. We just reduce it later, and no tolerances, no cures, no redisclosures, no need to do any of that. So that's a key point. Thanks, Jose. You fell right into my trap.
Yes. Hook, line, and sinker.
Yeah. All right. Why is this LTV? Oh, the property. So let me get to the next screen and we'll be able to adjust the property values here. So obviously we're retail on this, active loan. You don't got to mess with that. We do need to change this. This should be set to officer. John homeowner. Again, this is a fake social and all that. John homeowner, the fake person, is going to be an officer of the LLC that we're going to use, right? So the only valid business purpose is going to be officer typically, right? They're going to be the officer of whatever corporation or whatever is going to do this. The company information, if you guys are on our team, make sure you put our company there as the lender. And this is obviously a fake address, fake former address. We don't need to fill any of that in. We're not going to do DU for this, so I don't actually need to pull in the fake credit report. I do have a fake credit report for John homeowner in case we need to run DU, which we've done in a couple of these examples, but we don't need to today. So I'm going to leave this out. Jose, what FICO did you use for everything, just so I can save it?
My guy's walking on water. 800.
800, okay.
800, yeah, he's walking on water. He's the best freaking borrower out there.
All right, cool. And then we're going to change this up. So this is for some reason, that's just our weird test address. So let's actually put the real address in here. It's, 608 North Rio Vista Boulevard. And it's a detached. And we're going to always put the zip. Please erase this stuff, guys. And no matter what, even anybody in other companies, don't get in the habit of typing in your city and state. Always let your system set it, because then you'll get all the proper settings.
By the way, I just wanted to quickly say while you're finishing this,
it'll pop this up. Sorry, go ahead.
I just want to say for everybody, while you're finishing popping those things up, if anybody needs additional information on this property, reach out to me, please. This is a phenomenal opportunity for any of your short-term rental investors. So if you happen to be talking to any borrowers out there that are looking to do short-term rental investment near Las Olas Boulevard, a block from the river there.
You have to say this is your listing, right, Jose?
Yeah, right. Right. Reach out to Jose, and we will give your borrower a little lender credit action there.
So I switched this up. I stole someone's test file, so I switched it to my name, so that, because since I'm licensed in Florida, whoever was doing the test file was just testing and had the default address in there. So I had to set that to get it. What's the estimated value? You want to put it at purchase price, or you want to?
Yeah, purchase price. We'll just.
So we have 195,000.
Yep, one. Yep.
All right. Why are we at 70?
I think we may be off on on the fives or something. I mean,
yeah. What? Wait. What did we? Oh, 1995.
Yeah, 1995000.
This is the correct one then.
Well, I can't see that, bro.
You wanted 995 is what you wanted.
Yeah, 1995000. 1,995,000 buckaroos.
There we go. Okay, now we're at 70. Okay, that makes more sense. I was off. Okay. blah, blah, blah. Everything else is set up here. Good, guys. Make sure. And remember, our team, the blue stuff guides you. Blue is required, obviously. So that indicates what you need to have set before you can even go to the next step. Everything else looks good here. Everything comes pretty much preset. The lender page. This is important here. Big deal killer here. This is legally a 2 unit, right, Jose? Can you? Why don't you pull that up and explain? Why don't you pull up RPR and show how we determine how many units this bad boy is? Because everybody has.
Well, I mean, I guess I could just go back to the RPR.
Yeah. Why don't you pull up your RPR tab and let's talk about that, because that's the number one question I get when meeting with LOs that are trying to set up their file is, what do I put? And there's only one answer. It's the legal answer, right? There's only one and one answer only. What the agent says doesn't fly. What the listing says doesn't fly. There's only one and one answer only.
Now, I'm lucky that in being a licensed real estate agent, I'm paying for my dues, and that covers this benefit, this NARRPR.com website. So you all can't get it unless you're a realtor. If you're a realtor, you all have RPR. So notice here on the basic facts, here's what we're already seeing. It does say it's multifamily and multiplex. Okay, that's good. But then it further breaks it down to duplex. And our terminology down here, a duplex is a 2-unit property. That's what a duplex is, 2 units. And that's why the address is listed as, 1 and 2. Number of units, 2. Look at it right there, 2 units. And then I think if we go a little further down, I think there's some right here again. Property type, public facts. This is pulling the information from public records. 2 units. There could be some differences there when we're doing the living area and stuff like that. But the 2 units part, no. You got year build, and then this is just a regular stuff. Again, 2 units, number of stories. So 2 units is like all over the place, right?
And if there's ever any ambiguity, guys, just remember that it's the tax records, right? Nothing matters, no matter what the realtor says, no matter what the real estate listing says, no matter what MLS says, no matter what someone thought they bought, no matter what the property inspector says, no matter what the appraiser says, even though the appraiser's got to correct this stuff. The only thing that matters is what's in public records and the tax, the county records, right? And if the appraiser says something different, guess what? Someone's got to give, right? Someone's got to, there's only one answer always, right? You can't have an appraiser says it's 3 units and you can't, and then tax records say it's 2 units. That you can't do the loan, right? Everything has to match. So
now,
very important question there.
One of the things I wanted to add, though, to that, which is a situation I ran into the other day with one of our MLOs. She got a deal and did some research and was pretty cool. Was in Miami-Dade County, and so City of Miami had previously already kicked out some new zoning, called Miami 21, which was allowing certain additional density, higher density uses of existing structures. So you got to look at the map, see where you fall in and the type of property that you have, and then they tell you what you can do. You can do like an ADU, this and that. Well, now, only 2 months ago, Miami-Dade County enacted a very similar measure. The county commissioners met, and through a vote of 5-3, they approved legally allowing subdividing a home single family zoning into 2 units. Now there is certain standards that have to be followed, and it only lets you turn 1 into 2. And they have certain additional requirements, but if the requirements are met, that would be a scenario where you'd have to know that was going on. I told the MLO to provide a copy of the ordinance with the appraisal order, because the appraiser, I'm sure, may not have had that request yet, because this is a weird one. I saw that, I'm like, no, that can't be possible. She's like, oh yeah, I looked it up, I think it is. And I'm like, oh wow, that's amazing, it just happened. So I think that's a house hack that we got to figure out a way to develop that on a localized level with the Miami-Dade investor market, which is really looking for additional options. And I really think that's a great hack to do, to get out there if we learn how to structure it right to get that one. So let's put that one.
Yeah, the entire state of California has that law, and so that's the new progressive laws. Like we talked about a couple trainings ago, guys. All the new progressive laws. Miami 21 is trying to be progressive, but they missed that. And now that California and all these other counties and other entities are adding that, obviously Miami-Dade wants to join that party, and there's going to be lots of others, right? The whole state of California is eligible for ADUs. And so are some other counties, obviously Miami-Dade. So the party has begun. So definitely good.
Yeah, man. At the cost that rentals cost over here is some, and the lack of availability is something had to happen, and that's seems to be a logical progression.
Yes, sir. That I think is at 1960. Is that correct, Jose? You got it pulled up there.
Yes, sir.
1960. All right. And let's continue on here. It's not a project. It is detached, 2 units. This is very common too, guys. Attachment type, just because it's a duplex, doesn't mean it's attached to another property. Attachment type means attached to another property that you don't own, right? So if your wall connects to someone else's wall that you don't own, and it's connected wall to wall like a townhouse, that's attached. However, this is a 2-unit house detached from all the other houses. So a lot of people get this question wrong on this exact scenario where it's just a standard duplex. It's just 2 units in one house. Just because they're attached doesn't mean that our property is attached to another property that we don't own. That's what this means, right? And again, property is just detached, right? It's not any of these other categories, right? So detached, even though it's 2 units, everybody always wants to put attached here. This is the correct layout for this type of duplex, right? Everything else is set here correct. This is very, very important, guys. When we're doing a business purpose loan, there's no such thing as holding title in name. So a lot of your LOS programs, and ours included, right, it defaults to the person's name. Most loans and most lenders do all loans to people. We're the opposite, right? Us as a lender, we typically do like 90% of our loans to entities. So whether or not we have the entity, we know it, we're going to put it. But if we don't have it, we're not going to leave John there, because it's not going to be John. It's going to be a TBD LLC. So most of our purchases come in like this, TBD LLC, because most investors create an LLC in the property address name, right? So this investor most likely during this purchase, once they get some sort of initial approval, will take the steps with the state to create, more than likely, 608 North Rio Vista Boulevard LLC, right? That's typically how most investors do it. So most of our disclosures for our team go out with TBD LLC. It's a very important we still put it. Don't just leave it, default. It's going to put John Homeowner there. You have to unclick it and actually erase John and put TBD LLC. If you know the name of the LLC, please put it. Same thing down here. Nobody uses other because 99% of other companies use this. But since we're not other companies, we're always going to put other and put LLC, particularly when we're investing in a business. So again, Encompass, Calyx, all the LOS programs are not set up for business purpose loans. So you do have to make sure you put these very important steps in place in order to let everybody know on the actual 1003 this is a business purpose 1003, right? Let's keep going here. Another indication it's a business purpose loan. It's not conventional. It's not FHA, VA, any of those other ones. It's a DSCR loan. And everything else is just already filled out from everything we've done before. Looks good, looks good, looks good. Blah, blah, blah. Cool. Part 1, again, this is all fake info, so I'm not going to take too much time in this. This is all fake John Homeowner default stuff you can get from Fannie Mae. If you go to fanniemae.com, you can grab the John Homeowner file and mess around with it. And we're not going to mess around with it really at all. He's owned for 2 years. Cool. We're buying a new property, whatever. I always put same as current. That's one thing that makes me a little bit of a pet peeve there. That way, if you edit their address, they're still going to keep their same mailing address unless they have a totally separate address. And part 2, our favorite part of our DSCR loans, This is the Fannie Mae test file. So they have fake job for fake John homeowner. But the beautiful thing about DSCR is we get to delete everything on page 2. There is no page 2 on a DSCR loan or a business purpose loan because we're not basing it on the borrower at all. Borrower is just there as a person that operates the LLC, right? So let's pop up the VOE. Let's just make sure we totally nuke anything that's in here. So we'll just totally delete that. We'll close this. Now we have the does not apply button. Definitely click that for your 1003 to indicate to everybody that the 1003 does not have any income on it and does not have any employment on it. So no additional income, no additional employment, no employment whatsoever. No previous employment, no employment on the 1003 at all. Everything's going to be unchecked. Now we'll move on to part 3. This is a very important part for our DSCR loans because this is really all we have, right? Is we have the property and then we have assets. So if we're doing a purchase, we must have our assets here. So this is just test bank or whatever, some default. So this person has 125. That's not going to make it for this loan, right, Jose? So this loan, they're going to need at least 500 G's to make this happen. Probably more, right? Probably more like 550 in assets to cover, the closing costs and everything. You see here, this default file for some reason has multiple deposits. So let's go ahead and delete. Notice this is a blank record, but I can tell it's there because there's a delete button. So let's delete that. Fake record. Let's delete this one that has some data, but it's still fake. I'm sure Jose is not going to accept a $5,000 deposit, so it'd probably be more like $50,000.
Not on that value.
Yeah. So this would be more likely the setup: $50,000 deposit, $550 to close. With some reserves. So this would probably be a setup that would actually fly for this deal. In this case, let's put his current primary and map this. So this should be mapped. This is his current primary. He's buying an investment property, right? But we still need to show that he pays his bills. So anything that comes up on his credit, and this did come up on his fake credit or whatever they have in this default file. So he's got this one credit line, mortgage account, and that's to his primary. Okay, no problem. We map that. Of course, any other stuff, you still need to import all your liabilities. I don't have a fake credit report for this guy. I just have the one fake. Yeah, it won't let me do it. But if you have the credit report, just press import. You do need all your trade lines. They're still going to check trade lines. It's definitely a requirement for DSCR too. Remember, if your customer comes in looking like this, we're going to have trouble, right? They're going to need more than one mortgage trade line in order to get a DSCR loan. So that's something that trips up a lot of our team members, especially newer ones. You think you got a deal, but something as simple as not having a credit card for 2 years, even a zero credit card with not ever using it is still a requirement, right? You still need 2 trade lines. This is one trade line.
For this loan amount, possibly, but there is an exception out there with a couple of these programs may not be this high of a loan amount where if you have 3 credit scores, then they don't look at the trade lines.
Exactly. But you just got to be careful, right? This trips up a lot of people. You have to read the trade line requirement. And DSCR sometimes have different ones, a little bit relaxed sometimes because we're not using their personal income. But they're more strict on mortgage, right? If there's a mortgage late, DSCR has a big problem with a mortgage late. Not so much do they care about credit, credit card lates and stuff like that. But mortgage lates are a big no-no for DSCR, so that you notice in their trade line requirements, they'll have a different section typically that explains the actual DSCR compared to regular requirements. Usually less trade lines is okay, but any lates on mortgages are a no-go, right? So just make sure you check that.
For this particular option that we're looking at here, they do have a trade line requirement, like you were mentioning. So this is not one of those three scores, don't worry about trade lines. They do have a trade line requirement. It's nothing weird, but they do have it. And on the mortgage history, and this is real important to note, 1 times 30 in the last 12 months, but 0 times 30 in the last 6 months.
So they'll take one late in 12 months?
Yeah, but zero in the last 6 months. So which means their logic is if it was recent, then there may still be a problem. If it was more than 6 months ago, we can deal with it if it was just one.
Mm-hmm. maybe the renter didn't pay that month and they got
Yeah.
stretched thin, So
Maybe-
one, maybe okay. But yeah, every investor is different, guys. Remember, so read those guidelines and they change, right? The trade lines is one of those ones that change and you won't notice it, right? Because the matrix you notice, right? You're over there pricing. Someone changes from their max LTV of 85 to 80, you notice. But someone changes their trade lines from 2 to 3, you really gotta dig in there, right? Okay. So obviously this won't fly. So in this case, we would need at least one other trade line. You said it was 2, Jose? 2 trades?
I believe so. Yeah, I believe there's 2 trades with these.
Yeah, so 2 trades. So we need at least one, credit card or similar. Even if it's 0, guys, even if there's 0 balance and it's just a 0 payment. It's just been open for however long it's been open would be listed there, and obviously no lates would need to be there. So in this case, we would need at least these 2 in order to fly with this. Now, let's scroll down here. We already set this up. Remember, this is just their primary house, so this is just where the borrower lives. It's just their default thing. It's set as pending sale because I think this default file is for them to get a new primary, but we just switched it to investment. So he's going to retain his primary. He's still living there, right? He's still going to use it as a primary. It has nothing to do with this. We just have to list it because it's on his trade lines, right? It's on his credit.
And it's always R. I always want to make a note there. It's always R unless it's pending sale or unless it's sold. And you would only put it if it's sold if for whatever reason you haven't been able to update the credit and you have to offset the liability with an asset, or maybe you started as pending sale and now it's sold and that's where you got the money. That's the only time. But other than that, it's going to be R for retained. R does not mean rented, and we never use H for whatever reason. I don't know why.
Why do they even have that? That's weird.
Yeah.
Pending sale, PS, sold. So that's only if it shows up on their credit and it just hasn't cleared yet. So you need to still map it. You still need to show it. You're going to say, hey, don't listen to this because it's already sold. I'm going to give you documentation that it's sold. Same thing with pending sale. If you disposition something as pending sale, you got to have documentation of a purchase contract that's pending sale, or else you got to flip it back, right? It's not an accurate 1003. So if you mark it PS, you're going to have a purchase contract. If you mark it S, you're going to have a CD, right, that shows it sold, right? Actual closed transaction. So R is 99% of what you're going to mark. And there's no additional properties. He's buying his first rental property. In this case, Jose, if he has no rental experience in this trade lines, have you looked at or in the?
Yes, for this particular option, it's a really smoking option. They allow, mind you, look at these loan amounts we're talking about. I don't think the loan amount makes a difference. It's just the credit guidelines and the program. They allow a first-time home buyer who is also a first-time investor. And here's the caveat: as long as you can provide either a housing payment history, like rental payments for the past 12 months, or if they own another property that's free and clear, that they've owned that property for at least a year because they want to show 1 year's worth, quote unquote, of the payment of taxes on a free and clear property. So if you own that free and clear property at least 1 year, you can here's my last year's taxes. I paid taxes on that free and clear property. That's your housing payment history. Even though you would not be a first-time homeowner, you have your home, but you would still be a first-time investor. So first-time investor and or first-time homeowners, it is possible with those rental payment history.
And this is already set up. Page 4. We usually don't have to do anything, so we should be fine here. This is not going to be his primary, so let's make sure we set this back to correct. Obviously, this is an investment purchase. And then obviously everything else is just based on your borrower, but make sure you fill all this out. And that's pretty much it for itemization. Obviously, every company has their own fees and such, so we won't go into details there. But let's just go over a couple things to keep in mind. The points, Jose, what were the points that were on the 8% rate?
I think it was like, let me
slide
see.
it back over here. So that 8% rate was, is that the quote you have up there? The 20? No, you got the 20%.
That's one that I'm going to show you after we're done with this. I just wanted to show the example of the same loan type with a lower loan amount.
Gotcha.
But we'd have to do the math there. It was 11,000.
I can just type in. So this is a good example here, guys. You can type in percentage, or you can type in dollar amount. So if I don't want to do the math, I can just type in, what's the amount? 1309.
11,222.
But so we did 8.
Oh no, excuse me, 13,092. Yeah, we did the 8%. Sorry, I was looking at 8.125.
So we could put our points as just dollar amount, or we can put our points as points.
It's
like
like
Jose,
0.8 or something.
Point whatever the points are. It's actually way less than 2 because it's a huge loan. So that's under 1 actually. That's like 0.8 or something.
It's 0.874987. So
0.875.
yeah.
So if we wanted it to, normally we, when we do the rate lock through Optimal Blue, it's going to push through the percentage so that the math is correct. Even if you vary the loan amount a little bit, it's still going to be the points within that LTV bracket. The only other thing.
Pull up your Encompass screen again, Nick. You're on Jose's screen.
Oh, my bad. Sorry. Thank you. So you guys saw there, sorry, when Jose was talking, I put 13,000 here, but then when Jose did the math, I put 0.875 here. Make sure you always put bona fide. You still want to, if you can, get bona fides, even on the DSCR. A lot of times we got to pass the 5 points and fees. And if you can get some bona fides, if this 0.875 was really to buy it down, you can still get some bona fides on there to pass your points and fees test. So don't always think you're out of gas on the points and fees if it's a crazy DSCR deal, especially because some investors allow us to go beyond the points and fees, as Jose explained.
That's such an important point you just made, Nick, though. When you're sizing up the deal, make sure that the deal is doable. Mm-hmm. So especially when you're offering, I mean, the CRM doesn't really let them do it, over deliver like that. But, this particular option has no limit.
Mm-hmm. And then for prepaids, remember we're always going to need 12 months of insurance on a purchase. So if you import it as a purchase, it should import correctly. It should already be there, but just so you guys know, especially people out there that don't necessarily have that set up, or if you're messing around like we were on this file, it might not be there. Make sure you always got your 12 months on a purchase of your prepaids. And then your aggregates, super complicated here. Let's just do it before we end. I know we're going over time a little bit, but I just want to finish. Aggregates, you come here, click aggregates. You must have a estimated closing date so that then you have an estimated first payment date, and then you can actually collect your correct amounts. Taxes in Florida are due 11/1, and that's going to be 2023. And then hazard insurance, obviously we're going to collect 12 months, so our renewal is not going to be until a year after we close. So since we're closing on 2/28, that's going to be 2/28 of 2024. And we click OK. And boom, now we got our aggregate. So it collects the few months that we need, and then it gives us our refund based on whatever, mid period it's going to be closing in, right? So very important to set those key dates there. And remember here, when you're doing the aggregate table, if you put 2023 here, it won't exist because nothing can go in this field that is before the first payment, because these are escrows. These are things that are going to be collected with the payments, right? So you can't ever type a date in this box that is prior to this date. So if your taxes are due prior to your first payment, guess what? You're going to have to collect 12 months at close, or whatever your portion is at closing, right? So the one key thing is, if you look at this date, nothing here can be prior to this date. If it is, that's a prepaid, not an aggregate, right? You got to collect it at closing as a prepaid. Aggregates is for your escrows.
Talking about prepaid, did you input the 12 months for the purchase of the insurance?
Yeah, I did that first. So yeah, that was just up here. Yep, I said that just on the reserves, 12 months. It should default if you import a purchase, and it imports from the start with our team. But just make sure everybody knows you always got to put 12 there on a purchase. And then that's pretty much it on this, right, Jose? Everybody's got their own fees. We use Lodestar. So our team, you go into additional service, use Lodestar, it instantly populates everything and guarantees all the title fees. A lot of people use Smart Fees, some other features. The appraisal, make sure you click on appraisal. Use Appraisal Works for our team, where we can choose all of our 5 AMCs. That's pretty much it. Any other pages you want to go over, Jose, before we jump off?
No, that's a good thing. I just would want to tell them regarding Lodestar, if they do feel the necessity to set the Lodestar up before we meet the disclosure file, please only click on it one time. pick one shot, and that's it. Don't go back and say, now let me see this one, and now let me see that one, and no, let me go back to this one, because it's multiple uses every time you click on it.
I guess we could do it here, just so everybody's here. Just everybody can see how it works.
But you
So
should take out the other fees that are in there right now, because it may mess up the auto-populate.
Yes, that is true. So, good rule of thumb there from Jose. Before we pop up our Lodestar, we're going to delete. So these are just default fees that we have in, just so there's something there. Obviously, if you're doing like a quick calculation, there's at least something in there, but make sure you delete these, as Jose said, so they do not show up on your fees later. So we should start with 0 here. There should be nothing in our title fee charges. Then we can come over to our services. This is going to be Broward. This is the default Miami-Dade, so we're going to leave that default. The only thing we got to pick here is our vendors. So we have all these vendors that give us guaranteed title fees for this transaction. So we have like 1, 2, 3, 4, 5, 6, 7, 8 options. We have 10 total vendors. Obviously, 2 don't necessarily do Florida purchases, I guess. But these are all great options. I like to use Coast to Coast for refis, but they also do purchases in Florida, so I'll use them because I do promote them. They get us title work in 1 day, which is better than any other company. I love that we get our stuff to complete the whole entire loan in 1 day, 24 hours or less, typically.
Could I make a statement regarding, though, what you just pointed out regarding the deed tax for Florida? I mean, if you have a purchase contract, it's going to state, especially Florida, it's an real easy contract. It's not like page 3. It says who pays what. And it's real clear there that the seller pays the transfer tax on the deed, not the buyer. So if you've confirmed on the sales contract that that's the case, then you can uncheck that box, because that's the transfer tax on the deed, which is typically going to be a seller paid transaction. And it's a pretty high amount. It's 0.006. So you got to make sure.
Just make sure you collect the right amount, right? So that's the whole thing with this estimator. It's not going to be correct if you don't click the correct option there, as Jose pointed out. So that's something you got to do. And no, we can't know that for you, But you just click Export to Encompass, and this will be the last thing before we jump off. And it will show all of our fees, our smart fees, basically, our guaranteed fees from Lodestar, from Coast to Coast. Will be populated in the file, so we have some guaranteed fees that we can disclose with. And it's frozen up, but let me just pop back here, and boom, you see it popped in our endorsements, popped in our settlement fee, popped in our title insurance, and our lender's title insurance. So now we have a totally complete, and all of our taxes, all that kind of good stuff. So we have a totally complete, ready to disclose file with guaranteed title fees ready to go. And it is fully set up as DSCR. So this would be ready to go on our team. You would schedule a meeting with your team leader or Jose and disclose this bad boy. And we're good to go. So obviously we took a little bit of time there, but in less than an hour, if you guys are ready to go, you can get your file start to finish done and disclosed.
So hey, Nick,
that made
could you share my screen? Could I share my screen again in a minute? I just wanted to show before we get out of the meeting. I went ahead and I set up the quote for 20% down with the same short-term rental income use, right? I wanted to show that it is possible at an 80% loan to value to use short-term rental income as long as you can get on the 1007. So here you go. Just want to show you right here. Look at that rate. 8.375 costing 3/4 of a point. That's amazing. 7.5 costing.
Yeah, it's basically the same that we had at 75 on the high loan amount, but now at the 80 LTV.
Yep.
So great option there. But let's go ahead and wrap it up. Thanks everybody for staying longer. Let me pass it over to Kyle. You're not blocked as much this time, but you can go ahead and wrap it up, Kyle.
No, I wanted you guys to get to some of the questions because there was a lot of questions in here that people.
Okay, yeah. Before we go, sure.
Questions.
Let me get to Natasha's question. So this was a great one. I didn't get this while we were doing it. Oh, cool. When it pops you fully now. From a sales standpoint, if the 5-year PPP is a turnoff, so we're disclosing because the disclosure only puts one number and one number alone on all the documents, the maximum prepayment penalty. So we're going to disclose the maximum. What you actually quote the customer is going to be what you quote the customer. If you quote them a 3-year prepayment penalty, that's what we're going to do, right? But we're still going to probably disclose with that 5%. Five-year doesn't show anywhere, right? It's just that first number, that 5%. We're going to show that, right? Then when we close, it does say the number of years. So when you close, make sure everything's accurate. When we disclose, we want to always over disclose so we don't have to redo the whole file. So as long as we over disclose, Natasha, it's just on that one piece of paper, there'll be a little bit higher number. And it's just in case we do have to change and we don't have to restart the whole file. So it's not a sales tactic. Obviously it's not going to sound good as a sales tactic. It's a safety tactic to not have to restart. So if you can explain to the borrower, don't worry, we're putting that there. It's going to be final on your final thing, but that's just in case, so we don't have to restart later in case we need to switch programs or whatever we need to switch up later. So that was a good question for sure. Jose, you want to touch on that, or you good?
Yeah, I would just say that it's always good to provide multiple prepayment options to the borrower so they can decide which they feel is the most cost-effective action that fits well in with the objective. Because if they're telling you, I'm probably going to sell the property in a year to 2 years, then you'll put a 1-year prepayment option. It's going to have a higher rate or higher cost than the 5-year, but it depends on the objective. You give them multiple options. They decide if they're going to hold the property for 3, 4, 5 years. It doesn't really matter. They're going to tell you, Jose, I want 5-year because I want the lowest payment option. It's not like we're sneaking it in there. No, this is a tool that they are getting to use so that they can control their rate and the cost that they pay. It's good to have options. In a QM world, there's no options. They don't give you, let me add a prepayment penalty to bring my rate down. No, it doesn't exist. So non-QM it is. So it's great to have that option.
Beautiful. The other one right above that, this is an easy one for you, Jose. Easy to answer with ambiguity because every program is different. I think the minimum we have right now is 600, I believe.
620.
Minimum credit score for DSCR loan, yeah, it has to be at least 620 or I think 640. I mean, it really depends on if it's a purchase, on if it's a cash out, the LTV, somewhere around 620, 640, somewhere around there is going to be the minimum. Now, I don't know where Civic is. I know Civic was like or one of the options, I guess, for that, but I don't think that's an option anymore.
Let's see here. Trade lines. What are trade lines? Can they be mortgages or can they be credit card or multiple credit cards? Do you want to answer that, Jose?
Again, man, we got to defer on that to the guidelines to see what they accept as alternative trade line references. That's a tough one to answer. But I would say that it's probably going to be for non-QM. If they do require trade lines, I don't think they're going to be able to do all of them as alternative trade lines. They may be able to let you add one to meet the two, but one has to be real.
But the real are credit cards, cars, mortgage, all the stuff that pops up on your credit report and looks normal, right? So anything that pops on your credit report should be fine. Jose's talking about adding something that's not there. You can add and get creative sometimes with adding something that doesn't actually show up on your Experian, but they'll accept it as an alternative.
Like those self-reported accounts that people use for the Experian Boost. That works for Boost, but that doesn't work as a real trade line. That may work as an alternative trade line, but not as the main one if you don't have any trade line. Unless now it's an FHA loan and you're doing one of those no-score FHA loans where they let you do all alternative trade line references. That's a different story.
Here's a general question, but this varies by every property, right? So every property is different, right? So in Florida, you often have insurance greater than property taxes. But in some other places, like Texas, has notoriously high taxes and notoriously low insurance, right? So it's just totally based on where you live. And South Florida, Jose was explaining South Florida, right? If you're in North Florida, there's not necessarily, you're not even in a hurricane zone in some of those areas. You don't need any wind coverage at all. You don't have any flood coverage at all. But down here in South Florida, we typically have, there's two different policies. There's your regular policy, then there's your wind or wind X if it's just wind, right? And then your flood. So there's really three policies required in South Florida. Everywhere else in America is typically one, right? That has everything covered and even includes, some of the other stuff that we like separate out and exclude. So just totally differs. Jose, you're more of an expert on that too. Is there any tips on that for them?
Man, I think the worst insurance state is probably Florida, but I think that like any other scenario, it's risk based. An older home with an old roof. I mean, a newer, older home with a new roof and new windows. That's a different situation. But older home, older windows, older roof, all of that kind of stuff. It could be crazy. So the best thing, everybody, is get a quote. Get a quote. Get that quote. They're gonna tell you in Florida we need a wind mitigation of 4.0. That's okay. We'll get that later, but get me a quote now based on what you expect average.
Everything else is a lot of just comments. We appreciate the support, everybody. Is there any Jose, this is a good one from Brad. What appraisal company will do the short-term rent on the 1007?
Well, that's a hit or miss.
It's a moving target, right?
That's a hit or miss situation. I mean, I'm not gonna name the companies. We could get into that over an email or call me, but I've had a scenario where orders were put through the same companies requesting 1007 short term, and MLO was able to get his, and I was not able to get mine. Mine was in a much more short term rental market than his, but I just got stuck with an appraiser that didn't want to do it. The appraiser went and said, "No, the old timer, I guess, talking about conventional loans and what they're going to accept, and that's not up to the appraisal standards of UPAP." I'm like, none of this pertains to my loan. And then I went back and forth with the appraisal management company, took it out of there, went to another one that had gotten it done for somebody else. Again, same stumbling block. The appraiser that grabbed it, you didn't do it, didn't grab those, even though they were there. So but it does happen. It's just hit or miss. You gotta go and.
I think the right answer is almost everybody does it. It's by appraiser, right?
Yeah.
And everybody has the same appraisers, right? All these AMCs, they're gonna tell you they're special. But at the end of the day, if you're an appraiser, you're gonna sign up for all the AMCs, right? You're not gonna be a bad business person unless someone like burns you, right? Doesn't pay you. But if they're an AMC that pays their bills, typically the appraiser, a professional appraiser company, that has multiple appraisers on staff, they're gonna sign up for all of them, right? So they're all gonna get your same order, and it's just a matter who picks it up, really. So that's a great question.
All right, well, let's go ahead and wrap it up. We went quite a bit over time, but I appreciate everybody hanging out with us. Remember, we do this every Tuesday night at 7 p.m. Eastern. And then tomorrow night on Wednesday nights at 7 p.m. Eastern, we do our sales training. So we'll be right back here tomorrow night as well at 7 p.m. Eastern time. We thank everybody for tuning in. Thank you, Nick. Thank you, Jose. Great example there of how you can get the parameters of a deal, size it up, quote it up, and then actually pretty much originate the whole loan there and set it up all in Encompass within an hour is basically what we did there today. So awesome. Great example there. Thank you, everyone. We'll see you tomorrow, 7 p.m. Eastern time. Take care.
Thank you, everybody.
Thanks, everybody.